Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're doing incredibly well, that you've had a fantastic week. Do you have your Christmas tree up yet? We certainly won't be going in until at least the first weekend in December and hopefully a bit later than that. But I do know there are a few people in the office who are very into Christmas and they've already got their decks up. So I'm not sure if you fall in that camp or not. Anyway, I digress. What have we got for you this week? We're going to do our usual roundup on what the lenders have been up to in terms of pricing and criteria changes. We're going to touch on the latest inflation data that came out last week, the impact that's had on swap rates and also the kind of longer term outlook for base rate as well. We're then going to share with you some unexpected news that came out about the housing market, and then we're going to finally wrap up with question of the week. Okay, so last week we had the inflation news that came out, which told us that inflation had come right down actually to 4.6%. Obviously incredibly welcome news. I think everyone has been feeling fairly squeezed over the last 12 months. So fantastic news there. And actually the money markets have reacted incredibly well to this. So we've seen swap rates come down further, not as far as I'd like. I'm still desperate for my 5-year swaps to come in at under 4%. Alas, this isn't my week. Maybe next time, guys? But we have seen things come down. So in terms of swap rates, the 2-year swaps as of today, and today is Tuesday, 4.667. To give you some kind of perspective on this, 1 month ago, 5.035%. 5-year swap rates, again, they've come down, 4.094. I am so close, I'm within spitting distance here to the 4%. 1 month ago, 4.624. So actually a drop of 0.6% month on month, which is a really big step down. Now, there's been a lot of speculation in terms of base rate and when we can expect to see that start easing down. And some experts are predicting we could see a base rate reduction as early as August next year, assuming that inflation continues to behave as it's now doing, which is really promising. However, Andrew Bailey, who's the Bank of England governor, was actually interviewed yesterday and actually commented that it was far too early to be thinking about rate cuts, and borrowing costs actually might have to go up again if there were signs that inflation was proving more persistent than expected. And he's also added that the conflict in the Gaza Strip had added risk to the fact inflation could actually go back up again. So what he went on to say is that we must watch for further signs of inflation persistence that may require interest rates to rise. The MPC's committee's latest projections indicate that monetary policy is likely to need to be restrictive for quite some time yet, with an intimation that base rate could remain at its current levels or even higher until well into 2025. So, you know, I don't know in terms of it's going to be one of those wait and see kind of numbers, but those people who maybe are on variable rates paying quite large amounts, and are sort of thinking, well, actually base rate's going to come down probably middle of next year, just know that actually that isn't the consistent school of thought across all people. Indeed, the governor of the Bank of England doesn't have that school of thought. So with fixed rate pricing coming down and no sign of base rate coming down, well, for at least 7 or 8 months, it could be longer. Actually, there's a very strong school of thought that maybe now is the time to start revisiting your options and looking at maybe moving on to one of those much lower than they were a few months ago fixed rate deals. And I guess really just segueing very conveniently in from my last comment in terms of lender pricing. So another week, another wave of lender repricing downwards, which is obviously fantastic. So first up, we've seen Foundation Home Loans reduce pricing but up to 0.3% across their product range. And their product range is absolutely massive because not only they do normal buy-to-lets, they have different kind of tiers of pricing for different kind of borrower types, those with credit blips, for example. They also have a kind of semi-commercial offering where they can do much larger HMOs, semi-commercial properties, short-term letting, that kind of stuff. They've also got residential as well, so their product set is absolutely massive. But the key point here being that their rates have come down by up to 0.3%, and pricing generally starts from, on the more complex side of deals at least, so the semi-commercial, holiday lets, that kind of stuff, from 6.94. Now, we've also seen the Coventry make reductions of up to 0.2% on their rates this week. Unfortunately, they haven't actually launched the new one, so we know they're repricing today. I haven't actually seen the new rates yet, so I can't tell you what they are, but they have come down by 0.2% on where they were this morning. The Mortgage Works, again, reductions of up to 0.2%. So standard rates for these guys are now from 4.54% and limited company pricing from 4.99%. Aldermore have released some limited edition products. They've got 5-year fixed rates from 4.99 for their multi-property offering. So this is where you'll have multiple properties secured by one mortgage. So one mortgage secured against multiple properties. And actually for a single unit proposition, so one mortgage, one property, their 5-year pricing is from 5.09%. One of the really nice things about Aldermore, free valuation and free legal work, even if it's in limited company, it's quite unusual to find free legals in a remortgage in a limited company structure, and that's one thing they certainly have, so well done Aldermore. Kent Reliance have reduced their pricing, so now from 5.09 and part of the same group. Precise Mortgages 2-year rates are now from 4.39 and 5 years from 4.84. A question we get asked often actually is, if Precise and Kent are part of the same group, why are their rates different? So there actually were two very separate lenders who then kind of merged. Precise, I would say, is definitely the Group 1 savings banks more. They're still a specialist lender actually. They do more sort of standard stuff, so limited companies, small HMOs, small multi-units, but they're quite, black and white in terms of what they do and don't do. Kent Reliance is definitely more specialist. So these are the guys who have people picking up files and making proper commercial decisions. So as an example, I had a client who had some mortgage arrears circa 18 months ago. Kent Reliance can consider that one because it's historic. So very, very different lenders with very different propositions, hence the very different pricing from those guys. Now we've seen Landbay make reductions to their pricing of up to 0.2%. 0.2% feels like the go this week, doesn't it? Their rates are now from 4.69, and guess what? Keystone have reduced their rates by 0.2%. So their rates are now from 4.64%. So another real set of movements down, again, more in the specialist end of the market than the kind of high street clearing banks. Having said that, we have seen the Mortgage Works and the Coventry come down a bit. So not necessarily that rule applying to everyone. So in terms of where pricing is currently sitting, and I thought rather than just reading off a load of, rates start from X% if you're willing to pay a massive fee, what might be more useful is actually to give you a kind of example. So what I often talk about at Mortgages for Business is when we're talking about best deal, best value, what we're not just doing is giving you the cheapest interest rate, because the arrangement costs for that deal could mean that actually in the round, when you take into account the interest you would pay and the arrangement fees, that deal isn't necessarily the most cost effective. So we're very, very big on being very transparent about setup fees, valuation costs, legal fees, all those sorts of things. So what I've done is I've just taken a mortgage amount of £250,000, which at Mortgages for Business is broadly in the buy-to-let space, roughly our average loan amount here. So based on a mortgage of £250,000, if you're a personal borrower, borrowing against a straightforward property, your 2-year fixed rates are now 5.2%, from 5.2% with a 995 fee. Your 5-year fixed rates are from 4.5% with a 3999 fees. This is based on best value over 2 or 5 years, assuming a loan amount of £250,000. Repeating the exercise, but now moving into limited company lending, 2-year rate would be from 5.19 with a £4,000 arrangement fee, 5 years from 5.75 with a £1,499 fee. So actually, in terms of when I cast my mind back to a few months ago, there is a significant step down in terms of pricing on the mortgage rates, which is really fantastic to see. And I'm assuming that we're going to continue to see more pricing reductions filter through over the next few weeks. I know quite a lot of people are waiting to see how low things go. I do think there's room for rates to come down further. There's no escaping that fact. But what I'm not expecting is rates to return to the kind of numbers that we saw almost 2 years ago. So 5-year fixes at 2-point-something%, that kind of number. I suspect that 5-year rates are probably going to kind of bottom out for limited company lending, and the swap rates would have to come down to enable this, but maybe sort of like 5.5%, personal borrowing 4.5% to 5%, those kinds of numbers. So I think that's where we're broadly headed to, as long as the pathway of inflation continues to do what it's doing. We won't have some surge up, because that would then alter the plans for base rate, which would then alter swap rates, which then filters through to mortgage pricing. So things are still very much up in the air, but I think we're definitely on a good sort of trajectory at the moment. Okay, and 2 bits of lending criteria changes, both positive this week. So first of all, Kent Reliance have made a fairly punchy change actually. So they've increased the number of rooms they can accept on an HMO from 8 up to 20 rooms, which is huge. So there are a couple of other lenders who play in that space on HMOs in the buy-to-let end of the market, so without having to approach a commercial lender. Paragon is one, Landbay is another, so these guys can take on the lumpier HMOs. But 20 bedrooms is massive, so great to see Kent Reliance be able to accept those types of properties on their buy-to-let pricing. The other change we've seen in the last week is that West One have changed their rental calculation. So where you're taking a variable rate or a fixed rate, which is less than 5 years, the rental calculation they're using will be based on an assumed rate of 6.5%, which was previously 7.25. So essentially what they're saying here is that, yeah, you know, what we're going to do is assume that by the end of your fixed rate period ending, or your variable rates could go up to a higher level. So we therefore need to kind of calculate on that basis. But the assumed level that they're projecting on is come down by 0.75%. So that sort of shows confidence in the market, confidence in the trajectory of interest rates, and also it means, as importantly, is that with West One you can now borrow more per pound of rental income than you could do previously. Now, I know we've talked about house prices a lot lately because it seems to be in the news all the time because nothing grabs attention like a bad news story. But actually, the Nationwide have just released their latest house price index, and this has shown that house prices from September of this year to October of this year actually increased by 0.9%. So I thought, well, I can't read that and not share it with you. So here's the story. So indeed, house prices September to October of this year have increased by 0.9%. Now, year on year, so from October 2022 to October 2023, house prices are actually down by 3.3%. But actually the shift upwards was a little bit of a surprise for most people. Now, what I've been reading about and trying to understand is what's going on here, particularly given the sort of doom and gloom news that's been in the market a lot about house prices lately. And also I think it's important to understand what's happening, because if you are an investor and you're thinking about buying a buy-to-let property in the near future, there is a kind of element of timing in terms of when to go in and get something before the house market kind of turns a corner. And I know lots of my clients are kind of sitting and waiting and watching just to see how things go. So first of all, the report says that actually the change in house prices in the positive direction could indicate that we've hit the bottom of the market, essentially. And they attribute this to a combination of solid income growth together with lower house prices and mortgage rates, which means that it's actually starting to gradually improve affordability over time for home buyers, with housing market activity remaining fairly subdued in the near future. Now, there's been some commentary also supplied from a couple of people who know far more about the actual housing market than I ever will. So the first chap is a guy called Mike Scott, who is Yopa's chief analyst, and he said that the Nationwide house price index for October shows a 0.9% monthly increase, though the annual change is still a fall of 3.3%. This has come as a surprise to some commentators, but Yopa has been expecting a turnaround in the market thanks to the continued housing shortage, stability in the mortgage market, and a fall of over 10% in the house price earnings ratio over the past year. So this is essentially how much people are spending on their housing costs versus how much they earn. So there's been a reduction in terms of how much your housing costs are taking up of your income of 10% in the last year. They went on to say that this month's rise is larger than we might have expected, and so could be offset by small falls over the next month or two, but they believe that we have now passed the bottom of the market and that the trend in house prices over the next year will be for modest increases, with the market activity slowly returning to its normal level of around 100,000 homes sold per month. Now, Robert Gardner, who's the Nationwide's chief economist and obviously a very cluey chap, has said that the uptick in house prices in October most likely reflects the fact that the supply of property on the market is constrained. There is little sign of forced selling, which would exert downward pressure on prices as labour market conditions are solid and mortgage arrears are at historically low levels. And this is an important one to kind of comment on. So actually the number of properties being repossessed is like an all-time low, which you wouldn't necessarily call given the situation we currently find ourselves in. But there was something introduced this year called the Mortgage Charter, where lots of most UK lenders have signed up to it actually, which means that if someone is in a position of kind of weakness in terms of their finances, they're struggling to pay the mortgages, the lenders have kind of come up with different ways that they can work with borrowers to try and kind of salvage things and keep them in their homes. So actually this has meant that the number of repossessions has been much lower than it could have been. So well done to the government and the mortgage industry for putting that in place. So look, actually, in terms of the housing market, for the first time in as long as I can remember, some positive news in terms of house prices. And for those of you who are kind of thinking about next year now and thinking, you know, maybe with interest rates coming down, house prices coming down and therefore yields going up, it could be a good time to invest. This could be what your kind of initial warning, the shot across the bow, just to say that actually house prices may have now reached their bottom. And finally for this week, our question of the week, which has fast transformed into my favourite part of MFB News. So this week we were sent in a question, which was that the client was looking to acquire a property above a shop, and they were finding that a choice of lenders was restricted, and why was this? So from a lender's perspective, it's really all about resaleability. So lenders are always going to consider the worst case scenario. So if you weren't paying your mortgage, they had to repossess the property and sell it on, you know, how likely is it to sell for a given price, which would be sufficient to ensure that they got their money back? Now, it's all about desirability, I think, really here. So if you imagine a 3-bedroom semi-detached house in a nice, quiet residential suburb of a city, and we'll have loads and loads of demand for it. So most people could live in a property like that. Not everybody would want to or could live in a flat above, for example, a takeaway, a betting shop, a hairdresser's, you know, a very busy sort of high street location. So it's all about demand really, and the lender's confidence in terms of their ability to be able to essentially recoup their money in the event of a resale. And certain properties have, statistically over time, demonstrated that they are harder to sell on. If the property market is falling, these types of properties may face the quickest decline as well. But that's why you will find that some lenders decide to take a more restricted view in terms of not just actually properties above shops. I mean, this can apply to all sorts of properties, but being above a shop would be an example of one of those. In terms of resale. So so I hope that answers it. And actually, just interestingly, from our perspective, some of the things that we find can be quite contentious in terms of what's in the shop premises. So some lenders would say, actually, we don't mind lending above a shop as long as the ground floor, they tend to refer to it as sight, sound and smell. So if it is not open, you know, sort of unsociable hours, or sort of 10 o'clock, 11 o'clock at night, if there isn't music blaring out of it, if there isn't, for example, a takeaway where there's a real kind of sense of cooking and the smells that come with that moving up into the apartment, because this can all restrict desirability for people to acquire the property going forwards. Other properties which are a bit more kind of left of centre that we've had troubles with. So flats above dry cleaners, because of the chemicals that are used there, there's a fire risk. Same for hairdressers, incidentally. Betting shops is another one, because they can often be open quite late. So lenders can be a bit funny about those. Obviously things like convenience stores are open late, off licenses, those kinds of things. The other one which we had recently, which is a little bit macabre, was also undertakers as well. So lenders don't tend to like lending on flats above undertakers, just because, again, you know, some people may be slightly concerned about living in a flat above an undertaker, and therefore that would affect resaleability. So that's kind of what's going on. That's the thought process. If you are looking at a property which is above commercial or adjacent to a pub or any of those sorts of things, you know, generally speaking, there is always a lender who will lend on these properties. It's just a case of knowing where to go, and that's why you would give us a call so we can help find you the right home. And that's us for this week. So as always, thank you so much for joining us. I'm really excited to be coming back to you next week and talking about the autumn statement and what was contained within that, hopefully some good news for us as landlords, but also us as individuals as well. So let's keep our fingers crossed for that. But in the meantime, if you have any questions, give us a call, 0345 345 6788. Have a wonderful weekend, and I'll catch you next time.